The trends that are developing today related to branch transactions are generally as follows. Branch transactions are continuing to be viewed as a low-risk, cost-effective way for a branch to rationalize their footprint or right-size their franchise. From a buyer's point of view, branch transactions offer the buyer an ability to enter new markets, bolster their presence in existing markets, potentially acquire an earnings stream while doing so. From a seller's point of view, branch transactions offer the seller an opportunity to exit markets that are viewed as non-core, potentially increase capital levels, certainly from a capital ratio perspective, generally enhance capital ratios. Another theme that's developing related to branch transactions is you're seeing more of a trend of loans being included as part of the branch transaction structure. So when you're looking at the data and when you're looking at the deals that have been done, many of them today include loans versus a pure deposit acquisition or a deposit liability assumption transaction. The final trend I'll mention related to branch transactions is the size, really the dollar volume of the deposits that have been transferred in deposit acquisitions. If you look at 2011 compared to 2010, there were nearly 3 times the dollar size in 2011 versus 2010. Now, a lot of this volume was attributable to a small number of large transactions, but yet it does reinforce the attraction of branch transactions in today's marketplace. Related to trends in branch transaction pricing, we're seeing 2 trends develop. One, as I mentioned, we're seeing a trend towards loans being included as part of a branch transaction structure. Secondly, we're seeing differentiation between pricing in structures where loans are included and where it's a simple transaction where deposit liabilities are assumed and cash is received as part on the asset side. So what we're seeing is really over the past 3 years or during the financial crisis from 2007, 8, and 9, we were seeing deposit premiums paid or reported in branch transactions, both in transactions where loans were included and where it was deposits only that were assumed. The pricing was very similar. We're now seeing in 2010 and 2011 a very much differentiation in pricing, where we're seeing almost 200 to 300 basis points in differentiation. Loan transaction pricing might range for the deposit premium in the range of 3 to 5% in today's environment, whereas deposit premiums paid where deposits only are included in the transaction range in the 1 to 3 or maybe 1.5% range on the average. So key questions a board member may consider in contemplating a branch transaction would include, in addition to the pro forma impact to capital, to book, to tangible book value per share, and certainly to earnings, a board member may consider the value of the cash being acquired. They may consider the quality of the loans, if loans are included in the transaction. They certainly will want to consider whether or not an earnings stream is being acquired related to that loans, or if they're a seller rather than a buyer, they may consider the impact to the residual bank where they may be losing an earnings stream. Of course, there's a trade-off between, if you're a seller, reducing the amount of footings that you have at the bank by selling branches and assets, increasing the amount of capital or your capital ratios by doing so. And the trade-off is, of course, selling off an earnings stream and potentially gutting the bank's future performance in doing so.